Thank you. Thanks. Thank you, Surat. It has been pleasure getting this invite and happy to share some notes on how I learned my lessons while I was investing. These are all practical experiences which I would like to share. How many of you consider startup investing as a jackpot? सब लोग serious है एकदम. So this is, most of the time startup investing is talked about as, this is like a lottery. This is a gamble. No, it is not. It's a serious business and actually has to be thought across as a business, right? It's proper dhando karvano che, right? And this is where you really need to learn about art of doing investing. Right? There is no science in this. I'm going to share some formula, some graphs, some methods which will give you some science. But more or less still it remains as an art. And art, you need to get inspired, right? And TiE is the best place to get inspired. So let me just share some learnings. And these are hardcore experiences over 12 years of startup investing. So just to give you some numbers, આપણને બધાને રિટર્નમાં ઇન્ટરેસ્ટ હોય, right? એટલે as a Gujarati, most of the guys would be interested. So cash on cash IRR, right? Portfolio IRR is 113% over 10 years. What better rewarding business can be, right? This is the power of startup. This is where you can really work hard, and this is the only asset class where you can influence an outcome, right? Mahavir gave you the complete list of asset class, but none of this asset class you can influence an outcome. You buy a real estate, you can't influence a price. You buy across gold, you can't influence a price. But startups, if you invest, you can influence an outcome, right? You can actually work with the startup founder to help and scale the business, and you can actually influence an outcome. 100x, I started a formal fund after almost a decade of investing. 3 years back, invested over 105 startups. I found that there are not enough lead investors in India, right? And I always wondered across what is stopping people to put their neck out and say, this is a great startup, let me invest and take that lead. Very few people do that. And that's where 100x does the first check and invests and discovers the startups, right? We put our neck on the line, skin in the game, invest the money, and do the first check investing kind of stuff. We invest in a batch mode. We have a class 8 which is coming up on 21st of Jan 2023. In 100x, outside of my angel investing, we have done 105 startups which we have funded across. And we work across with the founders to scale. What I was telling about how we influence an outcome. We actually build companies, right? We are not like plain vanilla, okay, passively just investing money, right? We actually work with the startup founders. What's our investment thesis? This is what we think across when we invest into any startups. We invest in founders' vision, right? Whenever they pitch across, we invest in founders' vision before the world believes into it. So if they have already raised capital, I wouldn't invest because somebody already has done the discovery. I take the first risk in any deal, whatever I do across, right? So find the startup and nurture them. And when we do the funding, pitch is happening, what we look into it? We look into it that, the whole conversation which we are working across with the founder, what they want to do rather than what they have done, right? What's the future? How are they showcasing our future? Are we getting a new paradigm shift in the future, right? That's where we look into it. These are the two important things which we look into it, while we have got other parameters to check upon. Our success lies on these 3 pillars. And I'll just explain you, this is going to be little scientific, and if you want to take notes, take it across, but I'll share this presentation with all of you. You guys can take it from TiECon Surat. They already have the copy. It gives you a basic understanding of how venture investing works across. Power law of distribution is the first one. Second is building how do you construct a portfolio. And last is how do you index and do an indexing on startups. Power law. This is where it is, if you understand this basic understanding, you know how to select and invest in startups. It's all about understanding and investing in non-linear ideas, right? So in simple terms, it is always said that most of the investments in startup you will do across will fail, and very few of them will give you bulk of returns, right? It's a method of business, right? It doesn't mean that you were stupid enough ke pagal hato ne no I do invest karta. No, it's not that. It's just that this is how the investing works across, that startup idea fails, few of them will succeed and give you a bumper return. So that's why building a portfolio becomes very easy. And most of the time, we are thinking about frequency of success or correctness. Oh, this is the deal, ama to paisa doobse nahi. Let's invest. That's not how we think. In startup investing is, if this deal goes right, how big it will become. You think about the moonshot side of it. It's not the frequency of success, the magnitude of success. So the focus is about how large this will become across. Is this a moonshot idea? So every time we look into non-linear or exponential business. So let me take a poll here. Where will you invest? Meru or Ola? Both are doing the same stuff, taxi, doing stuff. Ola, everybody does that. Because it's a satellite, scales very fast and give handsome returns to their investors, right? So idea is everybody is smart enough now to understand where to invest. So I'm not getting into the whole selection process, but let me give you some math and science of selecting and building a portfolio. Now, these are some stats which I would like to share across, and these are real ones. The first one is not mine. The rest two are mine. The whole idea is $5,000 going into Uber gave across investors $25 million. Most of you guys would have $5,000 if you are sitting in the room. And getting a 25 million return on your investment is just phenomenal. The second one, Block One, is one of my portfolio company. It bought the shares which I had purchased at 1,200 rupees to 3.21 lakh per share. Look at the multiples, right? It pays for all your portfolio, and that's how you saw that IRR, which I showed you, right, earlier. The focus here is feed the winners and starve the losers. If I have to give you learning, is always work with the winners. You will have 20 company portfolio. In 6 months, 12 months, you will realize saying that this is a losing proposition. Don't invest time and money to salvage. अरे थोड़ा और पैसा देते वापिस आ जाएगा. Doesn't work. Feed the winners. Write more checks on the companies which are growing and scaling up fast. Right? It's an unfair world, and startup is an unfair place. But that's how you will be able to create wealth. This is how the chart works across and how the portfolio works across. Successful VCs need at least one outlier win, one win, to have a well-performing fund. This is how the VCs think across, right? So average portfolio, if it's of 10 and versus the portfolio size of 50, this is how the math percentage will work across. So if you have a chance, if you are a superstar VC, which means that you have done your work, you are working hard to select the deals, work with the founders, chances are 96% you will have a success with a one outlier win with the portfolio of 50 companies. These are all stats and math. Let me give you a small anecdotal example. In this room, if I have to do a normal distribution of 100 people saying that, let's work out an age, right? You will see, okay, some are younger, some is senior, and the middle age, kind of, and you will get a bell curve. If in the same room, if we try to find across saying that, okay, let's see the wealth of the room, and we have Mr. Mukesh Ambani in the room, suddenly every graph will go across. So, assuming this is a portfolio, you need just Mr. Ambani to be in your portfolio, right? And that's how the exponential wealth is created. Portfolio construction. This is the most important part for any startup investing, right? Most of you guys say, "Arey, ek do mein try karte." It's like buying lotteries. You are gambling. Unless you have a long-term working of 10, 12, 15 years and building a portfolio, it doesn't apply across, right? So you need to have, let's run this. Where will you invest? Swiggy or Smoking Joe's? Both are food brands. Swiggy, everybody knows where to invest, right? So you guys are all smart. Everybody in the room is smart. Apanne dhando khabar hai, where to invest. But idea here is, how do you structure, right? How do you find that one Swiggy or one Ola in the whole startup world, right? And be early in that investing. That's only where portfolio construction works across. So that's the chart which is there. It's called the flat, the elbow, and the wall. This is a standard chart most of the VCs will follow across. You invest when the things are flat, right? While valuation is low. You invest, double down with the follow-on when the company is growing across and the valuation is not crazy. You double down on that, and you don't invest at all unless you are a SoftBank or a big Sequoia type of fund when you have got infinite capital. So that's how you go on investing across. Budgeting, I'm giving you a model portfolio if you have to build across, right? If you got 2 crore to invest across, simple allocation over 5 years, 50% capital goes across for the first checks, 50% reserve checks for the follow-on investments. 20 companies first check, 1 every quarter, 5 companies check 20 lakhs, wherever you find a winners, invest in 20 companies to preserve capital. This is a math which is proven. If you have a 20 company portfolio, your capital is preserved. I'm not talking about returns. I'm saying capital is preserved, is guaranteed, because something will work out on that. And I'll give you a math on that. So portfolio construction strategy. I believe if you are investing at seed stage, which is early, lower valuation, you are an average investor. In terms of deal flow and experience, you don't have much. And your main goal is to get returns kind of stuff. You want to invest in minimum of 100 startups to get a decent shot at 3x to 10x kind of return. This is for blinder, like, just give a passive investing kind of. If you're a really good investor, 50 companies might work out for you. At least, so what I'm talking about is to build a large portfolio of startups to give you decent returns kind of stuff. And get that one unicorn and one outlier win, which will give you a successful outcome. This is an IRR example. Let's assume you are having a holding period of 6 years, expected IRR of 25%, target ROI is, let's say, 3.8x, and portfolio is of 10 companies. Now, if this has to work out, in early stage, typically most of the companies go bust. So, for example, 5 companies have gone bust where you got 0. 4 companies are there left. 5 are left. 2 are getting you 1x. The next is coming across just 3x kind of stuff. But one company has to give you 30x ROI to give you that. This is as simple as that. So one company gives you that 25% IRR on that 10 company portfolio, just creating a hypothesis kind of stuff. Future is designed and not random spray and pray. Lot of guys here think across startup is all spray and pray. No, it is designed. You actually have to work for it. It is not random, right? The success is not random. You actually work for it. And startup investment is rewarding, right? Most of the guys do 1 or 2 investments, 3 investments, 5 investments, and then suddenly back out saying that, oh, this is not working out. It doesn't work that way. It has to have a 10, 15 years horizon and building of a portfolio before you can see returns. Indexing. This is very, very important, right? What is an index? Where you structure across a group of companies, and startup where you can create with quality can generate compounding returns, right? Compounding returns. So you need to apply quality filter. You need to really work with the founders. Selection has to be right. And then across, invest into it. So typically deal flow evaluation for what I've seen across, I'm moving a little fast because paucity of time, but idea is random deals. If you get, let's say you are great on LinkedIn, you will get random deals saying that investors, you will do 500 deals which will come to you, you will do 50 meetings and end up doing 5 investments. If you do validated deals, these are like angel networks, which does the hard work of validating it. You do 100 deals, you get 100 deals, you do 50 meetings and 10 investments. But if it is a refer deal, like for example, TiE, or possibly somebody within your network, your friend is investing, he's putting his skin in the game, right? And he says, I'm investing, why don't you invest? That's where you are maximizing your time, because somebody whom you know has already validated and referred that deal to you, saying that this is the deal which I'm investing. So try and find out and build a network within yourself and start sharing deals at TiE Surat. 100x, what we do across, we get access to top tier deal flow. We see almost like 15,000 deals a year. 15,000 deals a year, right? And we end up investing around 50, 60 deals. 6 weeks, we call all these founders at Mumbai, work with them on various business aspects, help them solve the problems. Anybody who is investing into 100x deals, they don't have to pay any fee, no membership, nothing, and it's direct investing into startup. We earn revenues only on exit. We don't have any other model to earn revenues. So this becomes a platform where people can invest directly. And idea is it becomes like a finishing school for most of the startups. And we invest 1.25 crore for every deal which we invest into it. So first check is of 1.25 crore. And that's where the whole work begins across for those startup founders. What we do is take them from 0 to 1, and that's a Forbes article which has been published on 100x. We discover those moonshot ideas, convert those product ideas into business, build their exponential thinking, give them network of mentors and masterclass, help them to build the next level of business and next round of growth capital. That's how we work across at 100x. Data has proven across, and enough and more like AngelList, Let's Venture, a lot of online platforms, angel networks have given enough of the data to prove that indexing works across at early stage, right, and produces quality returns kind of stuff, superior, instead of just picking 1 or 2 deals across. So if, let's say, one has invested in every deal on 100x, chances of success is very, very high instead of picking 1 or 2 deals kind of. And, superior performance doesn't come at little later stage. It is always at your multiples happen at, early stage. I'll give you one example. These are both my portfolio companies, Box8 and Wow Momo. The first one, I had invested at 2.5 crore valuation. The second one, I had invested at 100 crore valuation. Both the deals are now at the same stage. Where would my alpha be? The first one, right? Because I had entered early. And my quantum was same at both the end. If you enter late, your quantum has to be significantly higher, right? And where I'm doing angel investing, and this session is about that, I invested the same checks at both the end, right? So both the companies in my portfolio, both the successes, and both are at the, so in fact, both of them have raised money from Tiger Global in the last round, right? So I'm just sharing across a live portfolio. What you need to do is assess the hunger for resources to grow across, right? Founders need to be hungry. When you meet a founder, if they are, mere ko 1 crore de do, mera life set hai, you will never make money, right? Unless the guy has hunger to, win the world and create the future, it doesn't work. And let's take a quick moment on what kind of diligence questions you will need to check across. This is what we follow. What is the reason why they are building this company? Very, very important, right? Understand their motive, why they are building this company, right? What's their unique value proposition? Next is ask them their positioning, right? And market opportunity, how big it is, and what is the market size kind of stuff. That's the second one. Third is, why would people need this product more and more? Is this a painkiller? Is it, need to have? So there are 3 types of stuff: painkiller, vitamins and candies. Painkiller are like abhi chahiye, right? You need a solution. So if the idea is a painkiller, you blindly invest, go across. Vitamins take lot amount of capital and consumer behavior change. And candies are luxury products and brands which gets built across over time. None of the businesses are bad, but idea is you need to pick and choose basis on your investment criteria. Why is this the right time to build a company, right? Very, very important. Like for example, economic impetus, like EV. Today governments are giving subsidies, the market has got huge amount of tailwind. It's crazy growing on the EV side. Pick up the market and take it across. We had seen in COVID, EdTech was booming across. Enabling technology, like for example, GPS. If GPS as a technology would not have been there, Swiggy would not have been there, Ola would not have been there. What are those enabling technologies? Build driverless car, make the stuff really change. What will happen in the future? And we invest in future. Next is cultural acceptance, reprogramming of consumer behavior. Everybody is on OTT. Our whole consumer behavior is changing, right? How we are working across. So think across on various parameters before you take investment decisions. Understand where you are now. We asked founders saying that show us the metrics, what kind of capital they would need across, what are the team gaps. Every team has holes, right? But they need to be identified. Why isn't everyone working on it, right? Ideas are nobody's monopoly. Ideas are dime a dozen. दूसरे जन क्यों नहीं कर रहे? Think across what's the competition, what's the landscape, what's the unfair advantage they've created across. So think across. These are all the questions which you need to, for quality filtering of deals, which you need to do. Why will you do better than the established incumbents, right? What's that secret sauce? Think across on those lines. This is the most important slide I would like to leave with you. Whenever the pitch is happening across, we understand money. Everybody understands the money in the world, right? So when they talk about and pitch is about saying that unmet need, is there money to be made, right? पैसा बनेगा या नहीं बनेगा. Next is team execution, right to win. Founder का background क्या है, सब कुछ. Are these people who will make me money? And lastly, financial projection, terms of investments and everything. How much money I can make? Three things. Is there money to be made? Are these people who will make me money? How much money I can make? This is just as a nutshell which I am talking about. We have to be greedy. Investor job is to be greedy. It's like, I was just last week I was in Kenya and I could see across lion killing happening across. I was like, my mother, and we are all vegetarian, mother said, hey, kaise dekh sakta hai, and all those. I was saying that poor lion will die if he's not eating. So we as an investor, if we are not greedy, we will die. We will not be able to fund new ideas. Our job is to be greedy. So think across money first and think across exits before you invest across. So until exit, everybody, our donation. काफी जन बोलते हैं अरे आप लोग चैरिटी करो, हम चैरिटी करते हैं, बाकी का टाइम चैरिटी है. Unless we get an exit, everything is charity. This is the 5 things which you need to learn if you want to become a startup investor. Bold commitments. You will never have full information while investing. Everything is unknown. पूरा detail कुछ नहीं है. There are no charts or reports and nothing to be read across, right? Bold commitments, ability to digest risk. Ideas fail, entrepreneurs don't. My success has been backing the same entrepreneur again after losing money with them. I know this entrepreneur is great. Idea नहीं चला, ठीक है. It's okay. Loan नहीं दिया था. That I have to beat a shit out of him to get money. But that entrepreneur was good. I would back his second idea and it has been successful. You lose 100% of deals you don't see. You need to look at every deal which is coming on your table. Really work. Make smart choices. Don't embrace risk. Jabardasti risk nahi lena hai. Right? So make smart choices. Borrow wisdom. Mahavir said about get a lead investor, somebody who is investing, use his brains, see why he's investing, talk to the lead investor, get some comfort, and then invest. Build an exit strategy. Most of you guys fail on this. You don't have any understanding on exits while you are investing. Most of the time, do a blind investing. Define an exit before entry. Right? एक रूम में आ रहे हो, entry का दरवाजा है तो exit का दरवाजा भी देख लेना चाहिए. Right? As simple as that. Define an exit before entry. 3 types of exits typically exist in startup world. Financial exit, strategic exit, and acqui-hire. Financial are the best where a VC will buy your stake. That's the best exit because they are thinking, okay, valuation बढ़ने वाला है and let's buy the stake out of the investor who have come early. Strategic where, it's a buy versus build and corporates give you good money, but not like, crazy like a financial investor. And acqui-hire is where you are salvaging your capital, right? It's just a basic saying that let's place this and get our capital back. That's one of my portfolio company. Uday is here, one of my colleague. I was a lead investor into that, and it was a very, very, tough exit where we had got multiple term sheets and we closed the round with the founder. So working on an exit is as much important, I would say far more important than just working on an entry, right? Exits are very, very important. And many times the decision taking is, at the exit offer, कि इसमें continue करना है, double down करना है, पैसा निकालना है. It's a very tough decision. How do you know about it? I mean, so I run a master class helping all these investors pro bono who are doing it. And I have a specific session on how to build exits. Some point in time we will work on that. Defining characteristics of a startup is often experimentation. A lot of the startups in the portfolio, including mine, which I will share across, is about saying that founders find their way out, right? So they start with one thesis, and if it doesn't work, they pivot to the second one and move on the market, the idea, and take the steps, right? So it's a temporary organizations which is discovering their business models. So this is one of my portfolio company, Bauxite, which I mentioned. Initially, when I invested into it, it was called Poncho. Poncho was a Mexican restaurant, and Mexican chain, they had around 7 QSR outlet. When we invested, we thought Mexican food, spicy, Indian palate, same hai, and Chipotle was doing great in US, amazing founders, so let's invest. But nobody was going out and eating Mexican, right? And that time, and this is, I'm talking across, I think 2013, 14, nobody was doing that. So quickly, the founders pivoted themselves to Bauxite, which was all desi meal, where they would have paratha and everything, and they would put a chole on top of it, and you can actually use spoon and fork to eat across Indian meal, right? Typically, we have to soil our hands to eat an Indian meal. And it just went crazily, and now they've got so many brands. It's called Eat Club. So startups keep on pivoting and changing across. So you need to understand that the ideas change, and you need to back those founders. Goal is to find the next big thing, which is going to be there. And I'll just share 2 examples of the portfolio. Left side is Kerala banana chips. I mean, when we saw across this founder, saying banana chips mein kaun invest karega, but we asked for samples. We loved the product so much. We invited the guy from Kerala. And in the pitch meeting, we asked him saying that what's the whole distribution, saying that he wants to have banana chips next to every Lay's chip in the world. And that was like a great statement. And we asked him how is he going to achieve, and he had some plans. We asked him, will you come to Mumbai? Without a, eye blink, he said, yes, I'll come to Mumbai. The guy was doing only 3 to 4 lakh sales a month, which today he's doing 3 crore sales monthly and growing rapidly. The second one, Pocketly. When we invested, these were 2 kids who came to pitch us and just had screens, where they were giving across pocket loans to the students, and they had great ideas. What we loved about them was as students, while they were working across, they had sold a software to their own college. And that made a decision saying that at the young, tender age, if they can do a transaction with their college and earn kind of money, it was a great idea, and let's back these founders. And it has an amazing story. In fact, I think I got one of your Surat guys, Dravya, who has invested and led has led the last round. That's my email ID. Short talk, quickly, trying to wrap it up. Sanjay at 100x.vc, happy to help anytime. Thank you.